trading family, what is good? Your boy Wildcard is back in the trenches with the Quiet Assassin, TB, and the tape already smells like a powder keg with a lit match sitting 3 feet away. The market ain't calm, it's coiled. Or premiums hiding in the corners, not on the surface.
Quick disclaimer before we get moving, nothing we say is financial advice. We're two guys talking markets, not telling you what to buy. Do your own research.
Rapid tape check. The SPY is green, a hair. The Qs are red, a hair. The VIX is up 5.4%. Oil is sitting at $84.20 a barrel. Monday, the SPY faded 0.47%, pressed 775 support, and held it. Pre-market is flat on the nose.
The week map, China retail sales Tuesday, United Kingdom jobs, and Atlanta Fed GDP. Now Wednesday. Thursday, we get United Kingdom and Eurozone inflation, plus Lagarde speaking. FOMC minutes. Wednesday, Aug 19th at 2 p.m. ET, don't let anyone fake that.
That's the setup. Now let's get into the real story. One war, two fronts.
Hormuz first. A tanker incident overnight, United Kingdom Navy reported a hit with a casualty. A fuel tanker went erratic and stopped off Keshmim, and Trump is floating language about declaring the strait a territory.
But here's the wild part. Both sides still say the Iran-Oman trickle deal is in final stages. So the tape's pricing the middle path. Both tales are live.
I spoke with Sterling before the show. He watches the physical oil market. The question, does a tanker hit actually constrain supply, or is it noise?
His answer matters. A hit on a fuel tanker is scary, but physical barrels haven't been removed from the market. It's a headline shock, not a supply shock, unless it escalates.
Right. If this stays a one-off, the war premium fades. If it becomes a pattern in the strait, then the supply math changes. That's the whiplash setup.
And it shows up in the energy sector, ETF, energy sector plus 8.83% over the week. That's war premium, not a broad risk appetite bid.
That's the first front. Second front is the bond market. 30-year yield at 5.32%, just below the highest level since 2002.
Just below the highest weekly close since 2002, be precise. TLT is sitting at a 20-year low.
The 2-year is flat at 4.186%. That's term premium, not a Fed signal. Treasury supply, war spending, copper near record.
Raytheon just landed $22.9 billion in tomahawks to restock the war. That's real money hitting the long end.
Casas Bahia filed for bankruptcy on high rates and tight credit. Credit cracks first, equities follow.
And the poster child is situational awareness. Up over 1,000%, down 67% in July, still up 80% year-to-date. Citadel rides in with $400 million.
The Texas hedge wasn't a hedge. It doubled exposure, concentration, leverage, illiquid junk. All three sins in one fund.
Leverage makes geniuses and corpses. 2 numbers, 1 sentence, move on.
Consumer front. Home Depot reports pre-market Tuesday, Aug 18th, est $4.71. The consumer read comes Tuesday from China retail sales, consensus 1.5% versus prior 1.0.
XLY, consumer discretionary, is the worst sector over 1 week, down 2.59%. The consumer is already leaning weak.
Strong or weak, the long end doesn't care. That's the same war, second front. Strong print means the consumer is eating the tariff. Yield story. Weak print means doves get ammo but can't cut because inflation is supply side. Either way, the 30-year collects the tax.
Auto tariff glimmer. United States and Canada are mulling 25% to 15% on vehicles. The fight is over which content gets deducted.
Japan, Korea, and the European Union are already at 15%. If it lands with full North American content, that's anti-inflation and pro-trade. First crack in the tariff wall. Names: Ford, General Motors, Stellantis, Magna.
System color, 1 line. My TFT algo added 3 small longs. Monday, Cisco, KLAC, IONS, brackets live. First Solar, still the drag. Cash is a position. No gut book callouts.
Earnings this week actually, there are major reporters today and tomorrow. Home Depot, Baidu, Toll, Audi, Lowe's, and Target. That's a notable calendar, not a dead one. We're not manufacturing coverage.
Economic calendar. Tuesday, China retail sales consensus 1.5%, prior 1.0%. China unemployment rate consensus 5.1%, prior 5.0%.
Wednesday, United Kingdom unemployment rate consensus 4.8%, prior 4.9. United States Atlanta Fed GDP, now consensus 4.3, prior 4.3.
Thursday is the macro day. United Kingdom. CPI consensus 2.5%, prior 2.6. Core. CPI 2.5 versus 2.6. Eurozone. CPI 2.9 versus 2.9. Core 2.5 versus 2.5. Lagarde speaks same day.
China consumer is the first read on global demand. GDPN, now at 4.3, says growth is fine. FOMC minutes are Wednesday, not a rate decision. Hot CP, I keeps the long end under pressure. Soft CP, I gives doves ammo, but the oil supply story complicates cuts.
Sector rotation. Leaders over 1 week. The energy sector, ETF Energy plus 8.83, XLU Utilities plus 1.31, the tech sector Technology plus 1.25.
Laggards, XLP Consumer Staples minus 0.52, XLB Materials minus 1.17, XLY Consumer Discretionary minus 2.59.
Energy leading on war premium, not broad risk appetite. Utilities bid is defensive adjacent. Discretionary lagging means consumer stress. Selective risk, not a broad rally.
International into the United States. Asia, Nikkei down 2.54%, Hang Seng up 1.41, Shanghai Composite up 1.61, Kospi down 1.5.
Europe, DAX down 0.43, FTSE down 0.06, Euro Stocks 50 down 0.58.
FX, dollar yen up 0.18%, euro dollar flat, dollar index flat. Nikkei down against Shanghai up is rotation, not carry unwind. Yen barely moved. If it were a carry unwind, you'd see yen strength and Nikkei and Kospi correlating down together. That didn't happen.
No forced deleveraging. Europe, soft, but not panicking. United States feed, flat futures, no yen carry shock. But the global consumer and inflation picture is still dense.
Portfolio hot news. The long end term premium and leverage knife. One war, two fronts. 30-year at 5.32, TLT at 20-year low, 2-year at 4.186. Term premium, treasury supply, war spending, Raytheon Tomahawks, copper near record, oil at 84.20.
Bull case, a steepener supports financials, energy, and utilities bid. The energy sector, ETF plus 83, XL, U plus 131. If the Hormuz deal lands and auto tariffs de-escalate, term premium could cool. Long duration gets relief.
Bear case, the long end keeps selling. Credit crack spread. Casas Bahia is the small picture. High multiple tech and long duration suffer. Consumer discretionary is already weakest. XLY down 2.59.
Second order effect. The market is doing the Fed's job long end, tightening without a hike. Financials outperform. Long duration tech and discretionary underperform. Cash is a position.
Names it touches, TLT, the energy sector ETF, XLU, the tech sector, XLY, the TFT algo, longs KLAC, IONS, and First Solar as the drag.
Here's what we're watching tomorrow. First, the SPY at 775 Monday held it, losing that opens the next leg lower.
Second, the 30-year yield at 5.32% and TLT. The long end is the battlefield.
Third, oil at 84.20 and the energy sector, ETF plus 83. Hormuz headlines still live.
Fourth, Wednesday data, United Kingdom unemployment, 4.8 consensus, Atlanta Fed GDPN, now 4.3. Thursday, United Kingdom and Eurozone CPI plus Lagarde.
Keep your stops tight and your minds tighter. This is wildcard signing off trade. Smart or don't trade at all. TB, you got anything?
Watch the long end. That's it.
Trading family, we're out. Hammer down. See you on the next tape.